This is Eric Brotman, the host of Don't Retire, Graduate, the podcast that teaches you how to advance into retirement rather than retreating. And this is Office Hours, where we answer questions that listeners just like you send in. We received a question from Amy, who asked, what is the best way to figure out if a single premium life insurance policy is a good idea? Amy, that's a fantastic question, and one we don't face that often, which means you must have been in either doing some research online, or you may have had this type of policy suggested to you by an insurance agent or someone. So I'll do my best to capture this. A single premium life insurance policy is barely life insurance. It is a modified endowment contract, which means that it doesn't have all of the tax benefits that a traditional life insurance policy would have. And that's because years ago, the government decided that if there weren't at least 7 payments into a life insurance policy, then it was designed primarily for tax purposes and not for insurance purposes. And so they gave it a special place in the Internal Revenue Code, which generally isn't favorable. So let's start with that. The reasons to look at a single premium policy, there are a few exceptions and a few places where this can work really well. One of them is if you have several policies that you've had for a long time. Maybe they were universal life policies from the 80s. Maybe they were variable life policies from the 90s, and they're not performing particularly well. For whatever reason, there are ways to exchange the existing cash value in some of your policies into a new single premium policy, and because it's done by exchange, you may be able to avoid the modified endowment contract rules, the MEC rules. In that case, if the primary purpose for the insurance is the death benefit, and you want to have that death benefit guaranteed to a certain age, and they'll run them all the way to age 125. If you want that, this is a great way to do it because it allows you to never have another premium and to use underperforming policies to create a guaranteed policy. So that can be one exception. The other exception is in certain hybrids. There are certain cases where doing a single premium for life and long-term care insurance in a combined way can make sense because it can be a financially reasonable way to buy long-term care. So there are exceptions to the single premium rule for that. Lastly, I would say that in those rare occasions where you're trading a lump sum now for a lump sum in the future, and you do not need access to your cash value during your lifetime, you can use a single premium universal life contract. You can pay a premium. You can know the death benefits there, whether you live 6 months or 60 years. And as long as you don't need access to cash value, that can be a suitable way to guarantee a death benefit when you're gone. In the absence of those options, there are usually better ways to fund life insurance. The 7-pay rule is hard fast. That is IRC, Internal Revenue Code 101, basically. However, there are companies that do contracts that are 7 payment or 10 payment or 15 or 20. I mean, you can structure them any way you want to, but that will accept a single deposit into an interest-bearing account that will then make the future premiums on your behalf. So that if you want the discipline, if you have the discipline to pay the premiums every year, you do that yourself. But if you don't, some of these companies will pay 2 or 3%, which is so much better than you're getting in a traditional savings account or money market today anyway. And so because of that higher interest rate, you wind up with a smaller check to write than you might have if you had written the 7 or 10 or 15 checks. So that option exists. One plus is it doesn't create a tax issue for modified endowment. Another plus is if, heaven forbid, you should pass away in the 3rd year, the amount that's sitting in that bank account is still yours because it hasn't actually been used to pay premium. So it's actually there in addition to the death benefit in the event that were to occur. So there are ways to structure using a lump sum. You can also, Amy, do this yourself. If you know, for example, that you've got a 10-payment contract and the payment's $5,000 a year and you want to set aside $50,000 to do this, rather than giving it to the insurance company, you can create your own sinking fund. It can be in short-term bonds. It can be in CDs. It can be in cash. It can be in anything that's not going to be market sensitive. And you can actually just make withdrawals from it every year to pay that insurance premium. You can set it up to be automated. You can set it up as a monthly draw from that account if you want to. There are lots of ways to do this. So putting a lump sum toward a life insurance objective is perfectly fine. It doesn't necessarily have to be, and I put in quotes, a single premium life insurance policy. There are lots of ways to fund them. There are lots of creative ways to make your money work for you in that regard. I hope I've answered your question. I hope I haven't confused you. It's a technical place. If you'd like more information, we would love to hear from you. You can go to our website at bfgfa.com, and we'd love to hear from you. And if you want to look at specific situation, we're happy to do that with you. So, Amy, thanks for your question. Please consider sending us a question which we might answer in a future episode of Office Hours. For more, go to don'tretiregraduate.com. Post your question on our Facebook page or tweet us at Brotman Planning. Don't Retire Graduate is now a book available in print, Kindle, and audio formats. For more information or to order your copy, go to brotmanmedia.com/books or search for Eric Brotman on Amazon.com. Thanks for coming to Office Hours. Be sure to tune in for new content every Thursday. For now, this is your host, Eric Brotman, reminding you, don't retire, graduate.
Securities offered through Kestra Investment Services, LLC. Kestra IS. Member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC. Kestra AS. An affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Brotman Financial or any other entity discussed.